Really do appreciate you joining us today here on America's Retirement Headquarters, home of the Retirement Guys formula at America's Medicare Associates. 419-794-3030 is the phone number. The website, arhq.com. Let's do some hypotheticals here, guys. I want you to take two retirement savers with the same amount of money invested in the same funds for the same time frame in their 401ks. Just on surface level, you would think they would have the same results. But one could actually outperform the other by almost 10%, and the reason for that would be fees. The Morningstar financial site has found that the fees for a small company 401k can be almost double those for larger companies. So I know a fee analysis is something you guys do for clients. And if you were to do this and found this to be the case, what would be the next step?
Go ahead.
I was going to say, looking at fees is, I think, a crucial part in looking at the success of building on an overall plan. I mean, when you look at it over the long term, fees really do count. One of the things that I tell people is the cheapest isn't always the best, but there are a lot of financial products that we look at in the marketplace today that when you add it up and you start adding in, all of the layers of fees and expenses that it's associated with it, it oftentimes is stacked against the investor. It's stacked in favor of the house. And so, one of the key components, I believe, is looking at fees and making sure that you're trying to reduce or eliminate fees and expenses. There's a lot of, I think, great companies that are out there today. There's several to choose from, whether it's, Vanguard or Charles Schwab or Fidelity. And, these companies are on a mission to try to lower costs down as much as possible. I know, like in our portfolio, we talk about different companies that we love to own and invest, these higher quality, cash-rich, low-debt companies. And, in many cases today, we can go direct to the market and purchase these. And with some of these custodians or the holders of money that have eliminated trading expenses, you can really reduce some of the expenses down. We also have clients that will come in here and, they'll, before their clients have investments at other investment firms, and I'll take a look at them, and you'll add them up, and you'll be like, it's 3 or 4% in total fees and expenses. And so if you ask somebody, what's your expected rate of return, and if their expectation is that the market's going to earn 6 to 8%, and every year they're giving out 3 or 4%, they're, giving away half of their return every single year. Mm-hmm. The other exercise that I think is important for investors to look at when you're looking at, how do fees work on investments is look at breaking down the definition of total return. So most investors will only look at the bottom line number. They'll look at, what their statement said that their total return was for the year. But what I want you to do is I want you to break that down into growth plus income minus fees equals total return. So the growth is the ups and downs of the stock and bond prices. The income is the amount that you get that's predictable income from like bond interest payments or dividend income. And when you minus fees, that's the total cost. You need to have your, in my opinion, income higher than what your fees and expenses are, because otherwise you're starting off January 1st in the red, and you're just hoping that the market grows faster to offset the fees and expenses. So you want to start off in the positive. And one of the ways that we can do that is through an independent portfolio analysis. We can pull back the layers and take a look and show you how to point out exactly what your fees and expenses are, and then look at those areas. I mean, for the ones that add value, that's great, but for the ones that are not adding value, try to figure out how do you eliminate some of those fees and expenses. In this example, they talked about how the fees could be double for a smaller company's 401k than a larger company. Well, in a lot of cases, if you're over the age 59 and a half, it may have the ability where you could do a self-directed IRA rollout, meaning that you could take that money out of your 401k, choose a lower cost option if that was what was in your best interest, and then have a plan that was able to be more cost effective, once you reach a certain age. And I don't know about you guys, but I think fees really is a cornerstone to, being successful long-term when it comes to investing.
Yeah, I agree. In fact, fees have so many implications to the financial plan. For one, I always describe fees as the one area or one of the few areas that you can control. We can't control what happens in the market. We can't control what politician might be in office at the time, but we can control how much we pay for things. And so I've always been an advocate of, if fee is really only ever an issue in the absence of value. If I'm not getting anything for it, we're certainly not going to make you pay for a fee that you don't need. And so that's generally one of the main principles that I believe we stand for here at the Retirement Guys, which is that fees matter. Absolutely. And so one of the things that we help our clients do is determine where all the different source of fee is coming from in their portfolios. And that's one of the issues that I have, a strong issue that I have with the retirement industry in general, but particularly in the 401k space, is because they're not really required to report the fees and to make them as transparent as we are in, I'm going to call it the retail space, if you will. But, outside of the group employer plan space, the 401ks, 403bs, is just not a lot of transparency.
Sure.
And so it's difficult for the uneducated client or uninitiated client, I should say, to be able to ferret out where the source of expense is coming from. As you had mentioned earlier, Nolan, there's a lot of categories of expense and investments. The first and probably the most common is what we call the expense ratio. And the expense ratio is a cost for, in most mutual funds charge this, exchange traded funds, and pretty much any other investment vehicle. But it's usually expressed as a percent. It's for administrative and management operational expenses of the fund itself. So, for instance, if you had a $100,000 investment, it's a 1% fee, you pay $1,000 per year. You also have commissions in some cases. Brokers and other sales advisors are paid commissions for matching up buyers and sellers. That's a brokerage transaction, generates commissions. You also have advisory fees in some cases where you're not, you can buy and sell as much as you want, but you pay for the advice, the quality of the advice that you're receiving from the advisor as a percentage of the assets that the advisor is managing. And then in some cases, there's custodial fees from the actual person or company where the assets are held. But one of the takeaways here, I think, is the way that the Retirement Guys, we choose to register with the regulatory agencies and the things that we do here at the firm, in many cases, put us in the position of a fiduciary, which means regardless of what hat we might be wearing in that particular instance or situation, you can always rest assured that we're documenting the policies and the procedures and the methodologies that we used to make our decisions. Doesn't mean we're always right, but it means that we have a process and that we can document how these recommendations are putting our clients in the best position they can be in.
I know when I first started in the working environment, I had a 401k. And then all of a sudden, I get notifications that they're changing things over from A shares to B shares. Mm-hmm. And I'm like, okay, what the heck is this? I had no idea at the time what was going on with that. And what I was told was, well, we switched things over because of fees. Mm-hmm. It's costing us less for a different type of investment for the 401k. Does that still happen?
Absolutely, it happens. And I would say you were blessed in that your company at the time had fiduciaries and plan, sponsors and administrators in the role that were doing that ongoing research and monitoring and comparison of the fees in the plan. Because as the plan grows, as Chris had mentioned earlier in the segment, the larger the plans, like anything else, enjoy economies of scale. The more people you have contributing to a health plan, a group plan, the cheaper generally it is.
Sure.
And so it's the same concept with investments. When you pool your investments, you should generally receive lower pricing. And at certain increments and breakpoints along the way, I think it does make sense for you to reevaluate and to say, hey, what are we paying for? Why are we paying it, more importantly? And is there a better option? And we do have a division here at the Retirement Guys. If you're a small business owner or anybody that may be thinking about implementing a 401k plan or some sort of employer plan where you want to sponsor a program or a benefit to help your employees retire more comfortably, give us a call. We'd be happy to take you through that scenario and what we offer.
And that number is 419-794-3030. It's not to say that all fees are bad, but it comes back to what Nolan and Chaz both said, value. Are you getting value for what you are paying? We all know, if cable prices are a little too high, we all have that conversation about cutting the cord when it comes to our 401ks, our investments. We don't all necessarily know how much we're paying in fees, so it's really difficult to assess what that value is, and that is where having something like that independent portfolio analysis, having that done, can really come in handy, show you what you are paying, and if you decide you're not getting that value, being able to look at other alternatives. But it starts with that phone call, 419-794-3030 or arhq.com.